Hello and welcome to Wall Street Training's Accounting and Financial Statement Integration module. My name is Hamilton Lin and I will be walking you through this presentation. Please note that these materials are copyrighted and may not be disseminated or reproduced without the express written approval and consent. Here we have a nice little handy exhibit in which we describe and show to you all the interrelationships in pretty colors of how all the different major items on each income statement, balance sheet, and cash flow are all interlinked. One note to keep in mind here when you're looking at this exhibit, just always think about this. Every single item on the income statement is also going to show up somewhere on the balance sheet and the cash flow statement. And the reverse is true. Just about every single item on the balance sheet and the cash flow statement is also going to show up on both of the other two financial statements. So whenever you're building a financial model, you always have to make sure that whatever you do to the income statement, it will have to be reflected somewhere on the balance sheet and the cash flow. Whenever you modify your balance sheet, you always have to remember somewhere it's going to hit the income statement and the balance sheet as well. So understanding the true integration of how these statements are integrated, that is very critical to understanding how to analyze a company from the financial modeling, valuation, and analytics perspective. Now I want to spend a little bit of time and go through three very quick, short examples of exactly how all of these items on the statements are actually all connected and tied to each other. We'll spend a little bit of time going through these examples. Each one will build upon itself, so make sure you understand the previous example before we move on to the next example. And then once we're done with that, then we'll look at totality, the entire totality of all of these accounting numbers, financial statements, and let's look at what they mean and interpret them to understand how we can start analyzing and crunching the data. And then we'll go ahead and we'll do a quick couple of exercises to actually iterate this with real numbers. So going back to our slides here, in this first example, we have $1,000 of cash that we have generated. That is what we will call $1,000 of revenue. This $1,000 of revenue we will have made in cash. We will receive 100% of all the cash in that time period. Employee compensation so far is $50, and you have only paid $25 so far. Folks, think about that. If you show me a business with these kind of margins, $1,000 of revenue, $50 of employee expense, you show me that, and I am there in a heartbeat. Okay, but now the key here is that I have not yet paid this $50. I've only paid $25 so far. So you already know that versus what I'm going to report on the books versus my cash, I'm going to have slight differences. On the income statement, the first statement we'll look at, the statement of income. Revenue is $1,000. We have total expenses of $50. We must recognize all $50 of this salary expense due to the matching principle. We use all of our employees' labor that time period to help generate the $1,000. Now, of course, you may say, well, some employees are not productive and I shouldn't count it, but you get my point. We will therefore show a net income of $950. When we show this net income of $950, we already know we have a potential discrepancy. What is the potential discrepancy? Well, it's very straightforward. Folks, look at my balance sheet now. I have a $1,000 balance of additional cash just from my revenue. Let's say it has $0 to begin with. I've only paid out $25 in cash so far because I've only paid the $25 as given in the assumption. That means that in my bank account, I have $975. However, I showed I have a $950 profit. I have a $25 discrepancy. How do we reconcile that? That is reconciled on the cash flow statement. I will show, first of all, through the indirect method, $950 in net income. However, this is an item called cash not yet paid of $25, which comes from my accounts payable balance, or specifically my wages compensation payable balance, or salary payable. And therefore, I add to that. And the question I'm going to ask you is, why do we add? Let me come to that in a second. We add to that, and then we get to our $975, which now reconciles to our balance sheet number, our cash. Folks, the question I'm going to ask you is the following. Why is it that I will add the $25? Again, this is called wages payable. Why add and not subtract? The reason why we add and not subtract this $25 is very simple. Net income from the income statement has been understated so far. Why has net income been understated versus my cash position? Very simply, because I've deducted the full $50 of this expense and therefore lowered my net income. However, from the cash perspective, I did not pay the entire $50, only $25. So I added back because net income has been understated via my cash position. And therefore, that is the reason why I add it back. Again, please feel free to refer to our additional exhibit on working capital to explain how this will impact our cash flow in a greater detail there as well.